Welcome back. The market is just holding up this morning. So after one good day and one bad day, today is a relatively quiet day. At least what you can say at this point is that it seems to be consolidating with a mildly positive bias. So 5150 holds. The breadth has not collapsed and fertilizer looks quite up and about. But let's talk about numbers. Upinder Zutshi joins in to talk about what Infinite Computer Solutions' figures looked like this quarter. Remember, new listing this one. Upinder, thanks for joining in. Just walk us through what the sequential performance was for Q4 first, compared to what you delivered in Q3, both on sales and profits.
Thank you very much for inviting me to your program. Last year has been, in fact, a great year for Infinite. It's a year and a quarter of major achievements, milestones for our company. This quarter, as you said, we successfully launched our IPO and also continue to grow our business. In terms of the numbers, let me start with the quarter ending March 2010. Our revenue for the quarter was 187 crores, a little over 187 crores, which is about $41 million for the quarter ending March 31st, 2010. In terms of the growth on a year-on-year basis, in INR terms, it was 43%, and in US dollar terms, it stood at about 55%. On a sequential basis, Q&Q growth rate was about 16.36% in INR terms, and about 18.26% in USD terms. That's the revenue. As far as our net profit after tax is concerned, it was about 22 crores, roughly translating to about $4.8 million for that quarter, which translates on a year-on-year growth in terms of INR, it was about 19%, and in terms of USD, it was about 29%. On a sequential basis, it was about 7.7% in INR terms and 9.1% in USD dollar.
What have you done in terms of an operating profit margin, Mr. Zutshi?
In terms of operating profit margin, just let me... it's about 17.2% as far as the EBITDA operating margin is concerned for this year.
You've done pretty much the same level the last quarter as well, at about 17%. Could you tell us the key pressure points that you're seeing, if any, in terms of wage pressures or any kind of currency fluctuations, and what kind of margins do you hope to end up FY11 with? Any ballpark figure?
Yeah, we'll be coming out, we'll be giving the guidance. See, as far as last year is concerned, from a margin perspective, we started off the year and given annual guidance with about 17% as far as operating margin is concerned, and about 12% as far as the margin after tax is concerned. So the year has been good, we've been able to achieve that. However, as we move forward, it's holding the margin is a combination of two aspects. A is the revenue growth and the kind of revenue that we have. We have a mix of revenue streams of different margin levels, starting off with application management, which has a particular margin level, going all the way up to infrastructure management, and then to intellectual property, revenue share-based business model, which has a different margin level. So it's a combination of all three. What share of each business line is going to have in the overall portfolio for revenue, that will determine the margin in terms of the percentage. However, having said that, what we expect to do over the next 12 months is to continue to grow at the similar rates, both in terms of revenue as well as EBITDA and net margin, as we did last year.
So what is it that you're guiding to in terms of top-line growth then for FY11, Upinder?
As far as the guidance is concerned, we're looking at doing a revenue of about 855 to 877 crores in INR terms, roughly about 190 to 195 million in US dollar terms, which translates on a year-on-year growth of about 28 to 32% in INR terms, and about 35 to 38% in USD terms. As far as our net profit is concerned, we're guiding from 99 crores to 104 crores next year, and translating it to USD, which is about 22 to 23 million dollars, which is a growth of about 25 to 31% in INR terms, and about 32 to 37% in USD terms.
Are you confident of delivering that bottom line guidance, Upinder? Because what's happened this quarter as well is that while your revenue growth is extremely robust, something seems to have eaten off your PAT level performance, which is why that is at a single digit, whereas what you did in revenues is 16% plus.
See, in terms of next year, if you look at some of the, as I kept mentioning the last time also, our basic business growth is largely comes from our existing client base, which is largely driven by the order book that we have. However, to supplement that, we were able to sign some very significant business deals in the last quarter, and one of them, which we had announced some time back, was a revenue share deal with a very leading telecom OEM. Which roughly is, it's a 10-year deal, and as per our estimates, it could be anywhere about $400 to $500 million over 10 years. So that particular deal is a very high margin deal, obviously, because it's the non-linear business deal. It's a revenue share. We expect to do about $20 million this year from that particular client. We were also successful in signing a very large government deal in India as part of the APDRP program for the state of Uttaranchal. It's about 125 crores in revenue, and that has a particular margin level. And the third one that we signed last quarter is an infrastructure management deal with a company, US-based company called IOG, which though the revenue in terms of the bill rates may be lower, but the cost structures are lower, thereby protecting our margin. So we're fairly confident as far as the margin levels are concerned for next year. We're very, very confident. The outlook looks very good. We have a strong client platform, the client base that is going to hopefully give this margin to us.
How much has telecom and media together contributed as a percentage of your revenues in FY10, and how much do you expect that to notch up by, just these two verticals?
See, obviously it's the biggest and the most dominant vertical that we have, and as a company we're focused on that and further building our expertise in that vertical. As of last year, it was about 57%, which was down, in last quarter it was 61%, but overall it was 57%, which roughly more or less at the same level as the year before that. So we expect the telecom revenues to grow as we move forward. However, in terms of the percentage, it may come down a little bit as the other business streams are going up.
What do you think you can deliver in? Yep. What do you think you can deliver in terms of an earnings per share, Upinder, based on the net profit guidance you set out of between 99 to 104 crores?
It would be around 22.5 to 23.5 rupees per share. That's the EPS guidance for this financial year.
Okay, Upinder, we'll leave it there. Thanks for joining in. That's Infinite Computer Solutions. Today's chart should come up on your screens. The stock has really moved hard, and I think it's based on the guidance that you just heard. The management says they should go on to do 855 crores and they should do about 103, 104 crores at the top end of the range in terms of net profits. If they do that 22.5 rupees that they are guiding to, the stock is trading at sub 8 times. So it's probably one of your cheapest mid-cap IT stocks, 13% up on the stock, reacting well both to this quarter's numbers and more importantly to the guidance that was just set out. Let's take a break on that note. When we come back, more on the market and more on the space that is under pressure this morning, telecom.